Hey there, everybody. My name's Allison, and I'm the Director of Risk Tolerance here at Simpler Trading. And I'm excited to share with you guys my 25% rule for trading. Now, for those of you who don't know me, I don't have the typical trading background. I didn't get a degree in finance or anything like that. I was actually a theater major. And once I graduated college, my dad, who had been trading shares for a while, was starting to learn how to trade options, and he wanted his kids to learn how, so that way they wouldn't have to rely on the man in order to make money and be able to support themselves. And I was the only kid who was like, yeah, that sounds better than waiting tables, given what my degree is. So let me start to learn. And so I maybe was like some of you guys. I started watching online webinars, watching YouTube videos, started paper trading to see if I understood. And then I jumped in with real money. And my first trade had completely won coaching fees that I had paid for and locked me in a nice profit. And from that moment, I was hooked. And I went on a winning streak actually a little bit in the beginning. But of course, as we know, will inevitably take a loss at some point, and I did. And that loss wiped out a huge chunk of my profits. And it was at that moment that I realized that even though I had some good trades and I was finding good setups, I did not have a good grasp of risk versus reward. And it was from that moment on that I really started to dive into understanding the risk side of trading and to make sure I had a way to not blow up my accounts, to not give up all my profits, and to still set myself up with a great risk versus reward scenario. And that's where this 25% rule comes about. So let me tell you of this method of setting up risk guidelines for your trading account so you don't end up like me, where one loser wipes out all your winners, and you can keep yourself a step ahead in your trading and in the right direction. What I typically like to do to help keep the emotion out of my trading is setting up my account so that way I know I'm never over risking on any one trade and I'm not over risking in the entire account. So for me, especially when trading small accounts, because that is my focus at Simpler Trading, I like to split my account into 3 different percentages. And it's 25% in one group, 25% in the other group, and 50% that is remaining. That is the ratio that I stick with, like I said, especially when trading smaller accounts. But of course, as we talk about this, you can see that you can adjust this depending on what kind of account you're trading and what you're looking for. For example, if you have a larger account, but this is your life savings that you're starting to trade, you might split this up differently into 15%, 15%, and 70%. And let's dive in now so you understand what those percentages are for and how they work for your account when you're trading. So that first 25% is allocated into new trade setups. And that does not mean that all 25% goes into one new trade idea. It's very easy when you have a small account to think that, oh, I need to make this money work for me. I need to throw money at the wall, see it grow quickly. And so a lot of times new traders will end up in a small account risking like 30 or 50% of the account all in one new trade idea. Well, what happens when that trade idea loses? All of a sudden, there's a huge chunk of your account gone. And for those of you who have not fallen into this state, you might not realize, but this is what I call the dark side of trading. And for my Star Wars fans out there, you might understand what I'm talking about. But the dark side of trading is when you let your emotions control you. And a lot of times, those emotions typically come into play when you're stuck losing money, right? When you have a loss, all of a sudden you might have a fear of missing out. You might revenge trade. You might think that you have to put even more money out there to try and recoup the losses that you just had. The opposite, though, can be said if you're winning. If you're on a winning streak, all of a sudden you think, oh, let me load the boat on this one because there's no way I can be wrong. And of course, it's always that one that you load the boat on that ends up being wrong and it takes away all your profits, right? I speak from experience when I'm saying this to you guys. So what I like to do, especially in my small accounts, but I think this is good across the board, no matter what size account you're trading with, especially if it's your savings, if it's your retirement, to split this across the board. So the first 25%, like I said, is split up into new trade ideas, into multiple new trade ideas. And you might be asking yourself, well, when I look at a new trade, how should I set up the risk versus reward for that trade? And for myself, I like to risk one to make as much as possible, meaning that I have a small risk with a really high profit potential, right? For example, if I risk one to make 5, it means that my win rate does not have to be very high in order to be successful in growing my account. I only need to be right 20% of the time to risk one to make 5. I could lose 4 times out of the 5, right? But that one winning time I have pays for the 4 times I lost and still keeps me net ahead. And obviously, if you have trading strategies that have a higher win rate, that works even better on a 1 to 5 risk versus reward. Versus, for example, if you risk 1 to 1, it's not necessarily a bad idea if that strategy has a high win rate. But understand, if your win rate is 50% of the time, you're break even, right? Because you might win one, but then you give it back when you lose. You might make one again, but then you give it back when you lose. And of course, if that trading strategy that you're using with a 1-to-1 risk versus reward on the individual trade is less than a 50% win rate, then you might find yourself not profitable in your account. You might find yourself losing. And so this is why not only do I look at what kind of win rate a trading strategy might be giving me, and I keep track of that, right? But I also make sure that I'm setting myself up with a risk versus reward scenario so that I know that if I risk 1, I make 3, meaning I only have to be right 30% of the time to stay profitable in my account. I think this is so important, and it's so easy for traders to lose track of this, thinking that, they might be scalping some small wins in here and there. It's consistent. But if that risk versus reward on the individual trade is unbalanced, where that risk is a lot higher than the profit potential, and you find yourself stuck in a situation where that ends up having one loser, right? That's how you can end up wiping out all the gains that you've had. So not only do I set up the account so I can't blow it up, but on my individual trades, I set it up so that I'm risking a little to make a lot. And I look for win rates and trading strategies that work bigger picture. The second 25% of the account is set up and allocated into management for any new trade setups that I might have. Once again, this does not mean that 25% of the account goes into management for just one new trade, right? That capital should be allocated into multiple management actions in case several of the new trades do not follow through after the entry. And this could be on, for example, maybe you're in a trade where the chart still looks great, all the indicators look awesome, but it's just taking longer than anticipated for the move to occur. And on options, of course, we have the issue of theta decay that could work against us. So you maybe want to add a little bit more capital to cost average because nothing's broken about the chart pattern, but you want to net average down that size. Well, that, for example, would come from the account that is 25% of the account allocated to management. That's where that comes from. And like I said, not all of that goes into one management idea. It should be split across the board. And then that means there's 50% of the account remaining that is left untouched. And I feel like this is really important for traders, whether you're a newer trader, whether you're trying to trade for income and you're trying to make this a living, or especially if it's your retirement, right? You shouldn't just blow up an account from bad risk management and lose everything you've worked so hard to gain. So 50% of the account is left untouched. And there are a few pros to consider with this action, one, you always have cash buying power available to you. Sometimes there are trades, like for example, credit spreads that technically need cash buying power available in order to close them out. I had this one client, no, years ago, over 10, probably like 12 or 13 years ago now. And he showed me his account and he was like, Allison, you got to help me. These are the trades I'm in. Do you see anything that I can do to work myself out of this situation? And basically, he had fallen into all the traps of the dark side of trading. All of his money was allocated into trades that were about to expire. All of them he had kept doubling down on and had, huge portions of his account in, thinking and hoping it would work out rather than following what the charts and the technicals were showing him. And worst of all, they were in credit spreads, meaning he couldn't actually close out of the trade because he had zero cash buying power left. So even if there was a little bit of capital to try and recoup, he was a fish out of water because there was no actual capital left in the account from a cash buying power perspective to buy back those credit spreads and end up closing it out. And ultimately, unfortunately, he had basically blown up his account. And once again, this is exactly why my passion when it comes to trading is to really teach everybody about risk and risk management, because it is so important. You do not want to find yourself in a situation where you've blown out your account. And it's a pitfall too many traders fall into. New traders who have been on a good win streak, right, can end up blowing up their account accidentally. Even traders with large accounts, right, who just really want to try and reach that, high level Warren Buffett life. Even them, unfortunately, if they don't have that right risk management, can end up finding themselves losing a ton of money. So this is why personally, I leave 50% untouched. The second main reason why I do this is because as a trader, you are going to have losers. That's just a concept of life. That's why I stick to this chart here on strategies that have a good win rate and a good risk versus reward scenario, because I know ultimately I'm going to have a loser. It's going to happen, but I want my winners to be able to offset those losers. And so if I do run into that situation though, where it just wasn't a good week, or maybe it wasn't even a good month with my trading, I have capital left in the account that I can pull out, that I can pay myself with. If you're a trader who's trying to trade off income and you've never pulled out money to pay yourself on a down week, do that, right? Because that, in my opinion, will really help set up your mind to be able to set yourself in a good spot for risk and risk management in your account. Right? For example, if you all of a sudden catch a flat tire, you're not stressing about where that money's coming from because it's tied up in too many trades, right? Oh, what should I close out of? What should I do? Instead, you have some of your money left untouched to where you can pay yourself to then go fix your tire or anything else. And so that's what I leave with the 50%. Now let's talk about worst case scenario here, right? You follow the 25% rule. You thought you were doing some good strategies. Maybe the market environment changed and it caught you off guard. For whatever it is, if you lose the first 25% of your account on new trades that did not work out, and hopefully those were split across multiple new trade ideas, right? It shouldn't be one trade that, lost 25% of your account. And let's say you lose on the second 25% from management actions of those trades that also didn't work out. Well, you're still left with 50% of your account untouched. And if this ever ends up happening to you, you really need to take a step back and reevaluate your trading plan. And if you don't have a trading plan, you should absolutely have a trading plan, because you should understand each and every time exactly why you got into a trade, what was your target for that trade, what was your thought process behind it, what was your risk versus reward, both for the account as a total as well as the individual trade, what was the risk versus reward, and keep track of that stuff. And so you go back, if you end up in this worst case scenario situation, you go back to that trading plan and you see where you might have made mistakes. Did you have too much FOMO trading, right? Were you putting on too many end of day pins hoping something would work out and it's just not the right market? Perhaps the market's shifting gears, right? Just like we're seeing now, perhaps it's going from more a consolidating choppy market into a bearish market, and you're still trying to trade for that consolidation rather than adapting your trading plan to fit the current market environment, right? And whatever those answers are, you make notes of them. And then once you determine where you've gone wrong in your trading and you feel that you're ready to jump in, maybe you've paper traded a while, you've proven to yourself again that, okay, you're on the right step, you're on the right track, and you're ready to jump back on the horse with some real money trades, you still have that original 50% of your account available to you. And once again, you don't risk the full 50% of that remaining account, right? You take that original 50% and you once again apply the 25% rule. 25% into multiple new trade ideas, 25% into management of any new trade idea that gets left behind, and 50% untouched. And you continue to trade with this fraction until ideally you bring your account back up to the original 100% that you were starting at, right? And then you can adjust those percentages accordingly. So one way the account could be split up is 15% into new trades, 15% into management, 70% untouched. Like I said, if this is your retirement fund where you're just trying to have some fun, making some cash on the side trading, right? Maybe saving up for a vacation or something like that, then you might not want to have as much capital risk out there. So you can always adjust this accordingly to fit in what makes sense for your account. Or if you're a newer trader, you might do a smaller amount until you build up that confidence to increase that risk size. So let me show you some real trade ideas that I've taken over in the small lots room at Simpler Trading. These are real money trade ideas that I alert out and how I stay within the 25% rule for my account in total. So this is an example of my 15-minute setup. This is a trade that honestly, I sometimes ask myself why I trade anything else because this is such a consistent strategy for me. To date for the year, we're at a 76% win rate. And of course, as you guys know, I keep my win-loss, my risk versus reward ratio there on top of that 76% win rate. So in this case, I was looking for a move lower. I ended up hitting target here and was able to take a really nice profit. So I jumped in for $1.60, and then I did what I call profit recycling by selling to open a credit spread at 230. And what this does is it turns my trade into a standard butterfly. So I avoid the pattern day trading rule, but I take my risk off the table and lock in a profit. And so my target met, I was in the trade at 846. My target met at 914 on the 9 o'clock bar for the 15-minute chart. And I locked in a 70-cent profit for the day, which is about a 50%, a little shy of a 50% return on the 160 of risk I had out there, which isn't bad, but that's not the max profit potential. On cash settlement for SPX, because SPX cash settles, so I let my trade go into cash settlement to avoid the pattern day trading rule in a small account. The day closed at 69.08 and 86 cents. That was right by my 69.10 pin for this butterfly. And so I got a bonus profit of 386 on the day. So in total, I had a 456 profit, 386 plus the 70 cents that I locked in. So 456 was my total profit on the day, which was, I want to say, a little over, I think it was about a 285% return on the initial 160 of risk, right? So I risked one and I made 2.85 that day off of that risk. And like I said, this strategy has a 76% win rate to date for the year. So it's a great win rate and allows me a great risk versus reward scenario. Another trade that we did in the small lots room was on XSP. We were basically looking, the trend started to turn bearish, momentum started to turn bearish, we had to squeeze. So all of this made me want to continue to short this to the downside. So in this case, I jumped in on the 18th, on that Friday, into the 660, 656, 653 debit broken wing butterfly. So it's a 4-3 butterfly with the 57-cent cost basis. And this was basically a 1 to 6 risk versus reward. The max profit potential would have allowed 6, and I'm risking 1 to make that. I ended up with the nice move lower on Monday, just going ahead and closing out of the trade early at $1.85. This gave me a 128 profit, which was a 224% return on the risk. So once again, setting myself up in my account so that I'm just using a fraction of the cost. I think the highest risk trade that I'm showing here was the 15-minute setup at $1.60 and a $5,000 account. That's definitely well within the 25%, right? A 1,250 is 25% of a $5,000 account. I used a fraction of that for this trade idea, right? $1.60 was my initial risk, a fraction of that for a small account. If it was a 10K account, right, 25% of that would be 2,500, a fraction of that size, right? So not all of that into one trade idea, just a small bit of that with a good risk versus reward scenario, a high win rate to be able to grow my account. This one, 57 cents. So even if you had as small of account as $500, right, this would only be about 10% of that account. Now that's still pretty high for a risk amount, but once again, it's a $500 account, so it's a very small account that you're starting with. Certainly for those of you with $1,000 accounts, $5,000 accounts, for those of you with the smaller size accounts, fraction of it, right? Well within the 25% rule. And once again, a good risk versus reward scenario, and took it off for a nice return. Here was another XSP trade. Now on this one, the idea behind this trade with this indicator, this is the quant pivot indicator over at Simpler, is that it typically does not the price typically does not close below these lines. 17% of the time it closes below this line, so that means 83% of the time it doesn't. And on this side, 5% of the time it closes below this line. So I knew the market was pretty bearish, but when I saw it started to break those levels that day, I was willing to put out a small risk trade with a nice profit potential in case it could get a bounce up, maybe some profit taking from the short side at close. But as we talked about, not all trades will be a winner, which is why understanding risk both for the individual trade as well as the overall account is so important. So like I said, on this setup, I was looking for price to get back above its L1 level, because only 17% of the time it typically closes below it, which means this trade had an 83% chance of working out. So I put 19 cents of risk out there. It's a 2-point width spread, so it was a 1 to 9.5, right? Just shy of a 1 to 10 risk versus reward scenario on the setup. In this case, as you saw with the chart, XSP kept dropping into the close. It just fell that day. So I ended up losing my 19 cents. It just expired worthless that day. But once again, it was a fraction of that 25% that I allocate into new trade ideas. And as you can see with the profits from the other trades that we had, that we put on, right, just that day, that same day, I had already taken a nice profit. So my profit outweighed the loss on this end of day pin. I was still up nicely for the day, still up for the week. So this is why when you have a good understanding of capital risk in regards to your account, as well as the individual trades, you are setting yourself up to succeed rather than be defeated by that dark side of trading, right? You want that Jedi mindset. You want to be cool, calm, collected, unemotional when you're doing your trading. You don't want your emotions guiding you, because that is when typically, in my experience, when I lose money and in turn could end up blowing up my account, which I will never do following this 25% rule. So it's why risk became my main focus around trading. Each time I took A trade, I constantly had myself analyzing the risk versus reward on the individual trade as well as for my overall account. And why anytime I look at trading or I'm developing a new strategy, like my 15-minute strategy, risk is always my guiding focus. So I hope this helps you out, guys. You can find me over in the small lots room at Simpler Trading. If you like the trade ideas you saw, you want to learn more about it, you want to learn more about options or small account trading, or if you just need help with that focus around capital risk to get yourself back on the right path of things, come find us over in the small lots room. Join us for a trial, and I look forward to seeing you there. Until next time, my fellow Jedis, may the trade be with you. Bye.